I think what the markets should fear is inflation. And at the end, the Fed will adapt to this inflation, even if it means at one point bringing rates up. If inflation is higher than 3%, it will be a negative interest rate for US still. And this is quite difficult to imagine negative interest rate for US. If we have a growth for the US, that will be around 5 or 6% this year. So this is negative real rates are an anomaly. So I think investors should fear about inflation numbers and make sure that if they are too high, the Fed will adapt.
But Fiona, the Fed continues to make the case that this is transitory and they don't believe in a stubborn pickup in wage growth expectations. Do you think that analysis is correct?
It's true to say that you don't see a pickup in wage, but you start to see a pickup in other things, in commodities. You start to see a pickup in freight, with the price of freight being quite high. You start to see a pickup in some areas of consumption. Car, for example, has performed quite well as a sector. You see airlines saying that they are happy with the reservation for the Eastern period. So when we will get on the other side of the bridge, to quote the lady before me, the growth will be strong as it was in other pandemic. Consumption will be back, and by the fact that production has been cut and capital expenditure has been cut last year, there will be some shortage that could result in inflation. Furthermore, people have put money aside during this period. Savings have been quite high in the US with the third fiscal plan of Biden, which is arriving at 1.9 trillion. There will be much more money in the economy. So we can imagine that when we get out of this vaccine and that enough people have been vaccinated to start living normally, growth will be there back with a vengeance, and that inflation also.